Hello traders, my name is Emeka. I'm a professional forex trader. So today I want to further give you I want to talk about an important subject in institutional forex trading, and this will help to improve your trading. Before I continue, I want to ask that you subscribe, like and share our videos. When you do, it helps the YouTube algorithm to enable our videos to be seen by more subscribers, okay, and more traders. You help to benefit more traders by sharing our videos, okay. So we are creating almost of this content in order to help upcoming traders to become better in forex trading. All right, so let's go into the video. Also, please try to turn on the notification bell when you subscribe, so that once new videos are uploaded, you can be able to see our videos. So today, like I said, I want to be going into this subject, and we are talking about institutional order flow, and market structure or market structure. Now, I wanted to know that price do not move in a straight line. The market does not move in a straight line. The buys, you don't just have continuous buy or continuous sell. No, the market moves in form of a wave. All right, the market moves in form of a wave, and we call this market structure. So understanding market structure is key and vital to your success as a trader. So you need to know the higher time frame market structure, and you need to correlate it with the lower time frame market structure, which will enable you to know the right direction you are to trade. If you are in the opposite side of the market, all right, you are going to be having problem. You need to trade with the trend. You need to move with the trend. You need to move with the market overall, the higher time frame order flow or market structure. All right, so now currently I'm in Euro USD daily time frame. As you can see, I want to point you to now. You see market structure here. There are two types of market structure. We have the bullish market structure and the bearish market structure. So before you get into a trade, you need to ask yourself, where am I on this trade? Am I in the higher time frame? Is the market in a bullish order flow or market structure, or in a bearish market structure? So it is suicidal for you to trade against the market structure. So here in this case now, you see market structure here, and this area is bullish. This is a bullish market structure. Price is actually creating higher highs, okay, higher highs and higher lows, higher highs and higher lows, higher highs and higher lows. As you can see, I've actually marked it out here. This is bullish market structure. Higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, and that's how the market is moving. It's an uptrend. Okay, at this point, this point we have a break in market structure. New highs, the old high is being taken out, and we have a higher low. Here we have a break in market structure. The previous high is taken out by price, and we have a higher low. All right, this is a bullish market structure. Now, what about the bearish market structure? Price is creating lower lows and lower high, okay, lower high, lower low, lower high, lower low, lower high, and price continues in that direction. Now, this is the first low in this diagram I've drawn. Now, price takes out the previous low, creating a lower low, and now price again takes out this low, creating a lower low, and another lower high is created. This is called the bearish market structure, or bearish market structure, or bearish order flow in your D1 and higher time frame. If you go to the weekly time frame, you see how this is the weekly time frame that still shows you that price. This is the price. This market now is in a bullish market structure. Here now, you see we are in a bearish market structure. The market is in a Euro USD weekly in a bearish market structure in the weekly time frame. All right. Now, you need to also know that there is also market structure in market structure. right? There is market structure in market structure. For example, now here in this high, this buy here, this buy wave, there are also higher highs and lower lows, higher highs and higher lows being created in the lower time frame. Okay, in this cell there are lower lows and lower high being created in the lower time frame. Okay, so you need to know where you are in the higher time frame and be able to properly correlate it with the you need to know where you are in the higher time frame in your chart and be able to correlate it with the lower time frame. Now this is the weekly. Let's go to the daily. This is the daily flow. Okay, now let's move to the 4 hour. Okay, you can see now what I was trying to explain. I've actually drawn it out so as to mark it out so as to make the video not too long. All right, now this is the daily time frame. We see this buy impulse. There are higher highs and higher lows in the lower time frame, which is the 4 hour or maybe 1 hour time frame. This sell impulse, all right, there are lower lows and lower highs being created in this impulse, this sell impulse in the higher time frame. Now to see it clearly, let us move to the 4 hour time frame. This is the 4 hour time frame. See what I was trying to explain? Okay, this is the 4 hour time frame. All right, this is the 4 hour time frame. You can see that in the weekly and daily, this is just one buy impulse, but you can see that in a 4 hour time frame or daily or 1 hour time frame, you can see there are also a bullish market structure being created. You see higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low being created just as I've drawn it here. And also in the bearish, there's also a bearish market structure also being created right here. You see there is a higher high, a higher low, a lower low, a higher low, okay, lower low, lower high, lower low, lower high, lower low, lower high, lower low, okay, which I have drawn here. But this in a higher time frame, this is just a one impulsive sell-off. All right, but there is a structure. This is called structure in a structure within a structure. All right, this is a structure within a structure. Are you with me now? So the earlier you understood this, the better for your trading. So now when you go to the higher time frame and see that this is just a sell impulse, okay, this is a sell impulse, then that shows that in a lower time frame you don't need to be buying here, you need to be selling here. Also, this you don't need to be selling at this place. You should be buying because it's on a bullish order flow. All right, you don't need to be selling here, you need to be buying here. So once you understand that, it helps to improve your trading. Now before we wrap up this video, I want us to talk about mitigation. Actually, in our previous videos in this channel, we talked about demand and supply zones, and bullish order blocks and bearish order blocks. Now institutional traders buy in at the blocks and sell at the blocks. Okay, now that is what we call the institutional order blocks. All right, they do not actually trade with stop losses. Institutional traders, when they want to enter a buy position, they first go for a sell. The reason they do that is to drag the market in the opposite direction, in a way deceiving the retailers, so that the retail traders, so that they will go in that direction, and then they take out the liquidities or the stop losses by going in the original intended direction they wanted to go. But when they do that, they will have some drawdown, some form of drawdown. Okay, they will have some form of drawdown because they do not trade they do not trade with stop losses. They will have some drawdowns. Even when they want to, even when they have gone to the opposite direction, all right, of the trade. So for this reason, they need to come back later to mitigate their orders. For example, now you see here, this market sold. The institutional traders came back to this order block to mitigate their orders and sell. Let me explain what this means. You see, the market sold. All right, this structure, there was a break in market structure at this point. Okay, the market structure was broken, and now price went right up, creating a lower high. Okay, and this demand zone was broken, breaking market structure, but the institutional traders have, or the institutional traders or the hedge funds and the banks, they have some unmitigated orders right here. So the price had to come back to mitigate this order and then to sell. That is to close some of the orders here and then to sell. All right, so here now the same thing happened here. They sold the market right here and came back later to mitigate their orders. Let me explain it in a way that you understand. They came back right here, just a tap actually, to mitigate their orders, and they sold. Okay, here now you see this structure was broken. This lower low was broken by price, but there was no mitigation right here. There was no mitigation, so the market continued to sell and sell, but they still have pending orders right here. The institutional traders still have, the hedge funds and banks and institutional traders, they still have pending orders right here, because they do not trade with the stop losses, just as like we the retailers do. Okay, so now this market continued to sell until later on they had to come back to mitigate this order. Look at it. They came back right here to mitigate these orders. This was previously an unmitigated order. When we say unmitigated, we mean that the demand zone have not been tested. All right, unmitigated means price has not tested the demand zone or the supply zone. Here in this case now we're talking about the supply zone. Not until after several days. You see, this order block, or rather the bullish the bearish order block, or this supply zone, was created on the 29th. As you can see, it was created on the 28th of September, but price did not come to test it or to mitigate this order. The traditional traders did not come back to mitigate the order, not until several weeks later, on the around the 5th or 26th of October, they came back to mitigate this order, to test the zone. And you see how a massive drop in price, a massive decline in price. All right, so you need to understand this concept. So whenever you are trading the demand and supply zone, you need to look for, number one, whether you are in a bullish or in a bearish market structure, and then that gives you the direction of your trade, the trend, the dominant trend in that market. So that means you should, if you are in a bullish market structure, you should be looking for only buy trades. If you're in a bearish market structure, you should be looking for only sell trades. Now, when you have identified the order flow on a higher time frame like D1 or H4, now you step down to your lower time frame and now look for unmitigated or untested demand and supply zones. Those are the higher probability demand and supply zones, those ones that have not been tested. So once you have identified those untested or unmitigated demand and supply zones, now you look out for price returning to those zones. That is where you should be taking your sell trade and your buy trades from. Okay, that is how to trade profitably and how to use demand and supply zones to your favor. All right, that is how to use market structure mitigation to your favor. All right, so as you can see here now, this is a mitigated supply zone. All right, this has been mitigated, or it has been tested. This supply zone has not been tested or mitigated. This is a mitigated one, so you should be expecting price later on to come back to mitigate or to test this supply zone. So this is an area of concentration for future trades. All right, So we shall be ending this video here. So if you need more insight, mentorship, more explanation, more mentorship and guide, please, you can actually chat me up from my Telegram group. The description box is the Telegram, the link to the Telegram group is the free Telegram chats and Telegram. The Telegram group is in the description box. From there you can get free chat signals and insights, and then you can also get my contact if you need private one-on-one mentorship. All right, you can get my contact from there. Please like this video, share it, subscribe to the channel, turn on the notification bell. I promise you more useful content will come your way as we proceed. Thank you for viewing the video and keep on succeeding. I wish you the best in your trades. Do have a great day.